What if I told you that one ETF could turn your investment into a tech-fueled fortune, while another could provide steady income for decades? If you're curious about long-term investing, ETFs or exchange-traded funds are a fantastic place to start. ETFs offer a simple way to invest in a variety of stocks, bonds, or other assets without needing to pick individual companies. They're perfect for beginners and seasoned investors alike because they help you diversify, which can reduce risk and improve your chances of steady growth over time. Today, we'll look at three popular ETFs for long-term investing: SCHD, VGT, and VOO. Each of these funds has a unique focus, so they can appeal to different types of investors depending on your goals. First up is SCHD. This one is all about dividends. It invests in high-quality dividend-paying companies, making it a great choice if you're looking for regular income along with growth. Next, there's VGT, which focuses on the technology sector. If you're excited by big names like Apple and Microsoft and want to tap into tech's high growth potential, VGT might be the one for you. Finally, there's VOO, which tracks the S&P 500. It offers broad market exposure to 500 large US companies, making it a solid, low-cost option for balanced growth. Throughout this video, we'll compare these ETFs across key areas, so you can decide which one or combination fits your investment style best. Chapter 1. Performance Comparison. Let's dive into how these ETFs have performed over the years. While past performance doesn't guarantee future returns, it can give us a good sense of what each ETF has to offer. Starting with SCHD, this ETF focuses on high-quality dividend-paying stocks, which helps to provide a steady income. Over the past decade, it's delivered an average annual return of around 12%. That's not as high as some growth-focused ETFs, but it's solid for those who prefer stability with a bit of income on the side. Then there's VGT, which is all about tech. If you're looking for big growth, this ETF has delivered, averaging about 18% annually over the last 10 years. That's a strong return, thanks to its focus on tech giants like Apple, Microsoft, and Nvidia. However, keep in mind that this also means VGT is more volatile. It can go up fast, but it can also drop quickly when the tech sector takes a hit. Finally, we have VOO, which mirrors the S&P 500. This ETF has achieved an average annual return of roughly 10% over the same period. While this might seem lower compared to VGT, VOO's broad market exposure makes it more stable, as it's not tied to the performance of any one sector. You're investing in 500 of the largest US companies across different industries, which helps balance out the highs and lows. If we look at a hypothetical investment of $100,000, after 10 years, VGT would likely give you the highest growth, followed by SCHD and then VOO. But again, each ETF has its own strengths: SCHD for steady income, VGT for tech-driven growth, and VOO for balanced exposure. So which one is right for you? It all depends on whether you prioritize income, growth, or balance. Chapter 2. Risk Metrics Analysis. Now that we've covered performance, let's talk about risk. Understanding risk is crucial because it helps you figure out if an investment aligns with your comfort level and goals. First up is standard deviation, which measures how much an ETF's returns fluctuate. Higher standard deviation means more ups and downs, while lower standard deviation signals more stability. VGT has the highest standard deviation among these three ETFs, meaning it's more volatile. Since it's more concentrated in the tech sector, VGT can see big swings when tech stocks rise or fall. In contrast, SCHD has the lowest standard deviation, showing it's the most stable of the bunch. It focuses on dividend-paying companies, which tend to be less volatile. VOO sits somewhere in between, providing balanced exposure with moderate risk. Now, let's look at beta, which shows how closely an ETF moves with the overall market. A beta of 1 means the ETF moves in sync with the market. VOO, which tracks the S&P 500, has a beta of about 1, making it the benchmark here. VGT with a beta greater than 1 tends to move more dramatically than the market. This could lead to higher gains in a bull market, but also steeper losses if the market drops. On the flip side, SCHD has a beta less than 1, which means it moves less than the market. This makes SCHD more defensive, especially during downturns. Finally, we have maximum drawdown, which measures the biggest drop from a peak to a low point over a given period. VGT has the highest drawdown, showing it's more prone to significant drops, mainly due to its tech focus. SCHD with the lowest drawdown is more resistant to big losses, which can be reassuring during market dips. VOO, again, lands in the middle, balancing potential highs and lows. In short, if you're willing to accept more risk for higher growth, VGT may appeal to you. But if you prefer more stability, SCHD might feel like a safer bet. And for those seeking a moderate path, VOO offers a blend of both. Chapter 3: Holdings and Sector Allocation. Now, let's explore what these ETFs actually invest in and how that impacts their performance and risk. SCHD is built around high-dividend companies across various sectors. Its top holdings often include well-known companies like PepsiCo, Coca-Cola, and Pfizer. With a strong focus on consumer staples and financials, SCHD is designed to deliver steady income and stability. This sector mix helps protect it from market swings because it's not overly dependent on any single industry. On the other hand, VGT is a technology powerhouse. Nearly all of its holdings are in tech companies, including giants like Apple, Microsoft, and Nvidia. With such heavy tech exposure, VGT can offer substantial growth when the tech sector performs well. However, this also means VGT is more vulnerable to sector-specific risks, such as regulatory changes or shifts in tech trends. So if tech hits a rough patch, VGT will likely feel it more than the others. Then we have VOO, which offers the broadest exposure by tracking the S&P 500. This ETF includes around 500 of the largest US companies across multiple sectors: tech, healthcare, finance, and more. While tech is a big part of VOO, it's balanced out with other sectors like healthcare and consumer services. This makes VOO a well-rounded choice, as it spreads its risk across different industries, helping to cushion against sector-specific downturns. In summary, SCHD is focused on dividend-paying sectors, VGT is a tech-heavy growth play, and VOO gives you a slice of everything. So whether you're looking for income, growth, or a balanced portfolio, each of these ETFs brings something unique to the table. Chapter 4: Valuation and Expense Ratios. Let's move on to valuation and expense ratios, two factors that directly impact your potential returns. Starting with expense ratios, these are the fees you pay each year for holding an ETF, expressed as a percentage of your investment. The lower the expense ratio, the less it eats into your returns. VOO has the lowest expense ratio at just 0.03%, which is one of the cheapest you'll find. SCHD follows at 0.06%, still very affordable. VGT has the highest expense ratio of the three, at 0.10%. But it's relatively low for a sector-specific ETF focused on tech stocks. Overall, these are all low-cost options, but VOO stands out for its minimal fees. Next is valuation, which tells us how expensive the ETF's holdings are based on metrics like price-to-earnings or PE ratios. VGT tends to have the highest valuation, as it includes rapidly growing tech companies that investors are willing to pay a premium for. This means you're buying into high growth potential, but also paying a higher price up front. SCHD, on the other hand, focuses on value, investing in companies that are generally less expensive and often undervalued. VOO sits in the middle, as it combines both high growth and stable, established companies. So, if low costs are your priority, VOO shines. But if you're willing to pay a bit more for tech's growth potential, VGT might be worth the expense. SCHD offers a middle ground, balancing cost and value. Chapter 5: Historical Performance and Dividend Yields. Now, let's look at how these ETFs perform when it comes to dividends and long-term growth. SCHD is a favorite for income-seeking investors, with a solid dividend yield of around 3.5%. It focuses on companies that consistently pay dividends, so you're not just relying on price growth, you're getting a regular income too. This is especially appealing if you prefer a steady return over time, rather than dramatic growth. VGT, on the other hand, isn't as focused on dividends. Its yield is only about 0.75%, reflecting its growth-oriented strategy. This ETF prioritizes reinvesting profits into the business to drive innovation and expansion. So while you won't get as much income, you could see more growth in the value of your investment, thanks to the rapid rise of tech stocks. VOO offers a balanced dividend yield of around 1.5%. This ETF includes dividend-paying companies, but also focuses on growth, providing a blend of both. With VOO, you get some income and solid long-term growth from a diversified portfolio of top US companies. So, in a nutshell, SCHD is best for those looking for reliable income. VGT is ideal if you're chasing high growth in the tech sector, and VOO gives you a bit of both. Each of these ETFs has different strengths, depending on whether you value dividends, growth, or a balance of the two. Chapter 6: Which ETF is best for different investment goals? So, which of these ETFs is the best fit for your investment goals? Let's break it down based on different strategies. If income is your top priority, SCHD is hard to beat. Its high dividend yield makes it ideal for investors who want a steady stream of cash flow. This could be a great option for retirees or anyone looking to supplement their income. Plus, SCHD's focus on established companies provides a level of stability that can be comforting during market downturns. On the other hand, if you're aiming for growth and are okay with a bit more risk, VGT might be the way to go. With its heavy focus on tech giants like Apple and Microsoft, VGT has shown impressive returns. This makes it a good choice for younger investors or those with a long-term horizon who want to capitalize on the growth potential of the tech sector. Just remember, this ETF can be more volatile, so be prepared for some ups and downs. For those who want a balanced approach, VOO offers the best of both worlds. Tracking the S&P 500, it includes a wide variety of sectors, giving you broad exposure to the overall market. This makes VOO a versatile choice, suitable for almost any type of investor. You'll benefit from the growth of large US companies while also receiving a modest dividend yield. Ultimately, the best ETF depends on your personal goals. Whether you prioritize income, growth, or a mix of both, each of these ETFs offer a unique path to long-term success. There's no one-size-fits-all answer here. The best ETF depends on your goal, risk tolerance, and investment horizon. Take some time to think about what matters most to you, and use that to guide your choice. Thanks for watching. If you found this comparison helpful, don't forget to like, subscribe, and check out our other videos for more investing insights. Good luck on your investment journey, and see you next time.